Welcome back. This is Siwin Yi from the Yi Real Estate Network. Thanks for attending. And today's topic, I'm going to share the Redfin report just came out today, December 13th, 2022. And the title is Rents Are Growing at half the pace they were in the summer and are expected to keep cooling, which should help bring down in overall inflation. Anyway, so by the way, once you finish this video, if you see the value of my information, please click the like button and also subscribe to my YouTube channel. And finally, it'd be nice for you to subscribe to my email database. So you can, on my website below, so you could receive free weekly newsletter on all aspects of real estate investing. Okay, without further ado, by the way, I want to make this a disqualifier, this article, Redfin. What they fail to say is that this statistics, this data come from Redfin on rents, they do not necessarily cover the single-family home residential rental markets rates, which is, I don't know why over the years, all the years I've been doing real estate consulting, as I take our investors to go to the cash flow markets to purchase entry-level, low price point markets to match the rent cash flow. It's just nationwide, these media sources does not necessarily have any kind of metrics, consistent metrics that track the rental rates on single family home throughout the country. So this data tracks apartment renting, but I will give you more details. So it's a little bit not, consistent, doesn't give you all the information you need, you guys out there, to make an informed decision whether to rent, whether to buy a home, and what geographic markets to buy in the US. So it is what it is. So meanwhile, we're just gonna have to go with what Redfin has researched, and then hopefully they will expand their data to include single-family homes renting. All right. So without further ado, let's go over the second paragraph. The rent growth is likely to continue cooling, says Redfin economics research Chen Zhao. He said asking rents are already down annually in 14 of the metro Redfin tracks, and we expect declines to become more common in the new year. But in case, again, each time negative headlines, oftentimes they are very deceptive. If you look at the bigger picture, the last 3 years, especially during the pandemic, the rent, because of the people are migrating to many different areas of the country, mainly in the Sun Belt areas, and with the advent of remote working available, many of the people have flocked into these Sun Belt areas, and really just creating a situation where the rents are, because of lack of rentals available in those markets in the South and Southeast and in the West Sun Belt areas. It has created, the landlord are able to raise in the past 3 years rental increases like 20, 30, even 40% rental rate increases. So this triple-digit rental rates increases over the past 3 years is unsustainable. So therefore, it's going back down to the normal rental rate increases, which coincide with inflation. So rising inflationary environment creates a rising rental rates because more people cannot afford to buy a home, and they are fighting tooth and nail, competing against other renters to bid on a home to rent. So that allows the landlord to raise their rent astronomically, skyrocketing. So that is my pure opinion, and because I'm into real estate investing, cash flow investors, and that's what I've seen over many years. So getting back now, the good my takeaway, which is sometimes quite different than other educators, real estate educators, if you will, in a YouTube channel. I look at things a little bit differently. Why? Because I've been doing real estate investing for the past 30 years, and I have consulted with thousands of investors throughout the country to buy cash flow homes in many different markets in the country. So I would say that I have a lot of confidence in making my opinions. If I have to refute the so-called mainstream media and how they report this type of real estate data, if you watch my videos over the past few years, you know that oftentimes I do disagree with this mainstream media in the way they report this negative headlines invasion. But I always take a deep dive into each article which I read, and in the end, I've used my vast experience in the end of each of my video and throughout each of my videos, for that matter, to give a very personal opinion that I have based on my massive amount of experience. So the good thing about it on this paragraph that I highlighted right here, it says the slowing rent, again, apartment rent, multi-unit renting, not single-family home renting, has slowed down, which will help slow inflation further. I like to hear that, don't you? So when it slows inflation, when the rental increases cools down, according to this article, it slows inflation will lead to lower mortgage rates, which should also bring more home buyers back into the market. Isn't that cool? Right? So who wouldn't want to have a lower mortgage rate so primary home buyers can achieve affordability so they can buy a home once the interest rate decreases from its current mid 6%, which put a lot of people out of the market. So having said that, the rental market summary dated November 2022, month over month, year over year, the median asking rent is $2,000. Month over month increase 1.2, year over year increase 7.4. So that's pretty good rental rate increases. So another takeaway that I have is if you are a landlord, if you are a prospective real estate investors buying cash flow homes to rent, you're in good shape because you're going to have a lot more renters that will be knocking down your door to rent, and you are able to increase your rent at least based on inflation. If inflation right now is 7 to 8% officially, if you're able to see year over year, median asking rent is 7.4%. That's, again, as I said, the rental increases will coincide with the rate of inflation normally. All right, so let's go further. Rents fell in 14 major U.S. metro areas. And in Milwaukee, the median asking rent declined 13% year over year in November, the largest drop among 50 most populous U.S. metros. Next came Houston, minus 6.3, Austin, minus 5.3, Baltimore, minus 4.4, and Minneapolis, minus 4.1. And here are the listing of 14 markets with the rental decline, the top 14 rental decline year over year. As you can see, Milwaukee, Houston, Austin, Baltimore, Minneapolis, Chicago, Denver, Atlanta, Dallas, Jacksonville, Boston, LA, Las Vegas, New Orleans. Out of the top 14, you would agree with me that a lot of these metros, or a lot of these regions are located in the Sun Belt, South and Southeast, and South and Southwest, because a lot of people are migrating into this area, especially during the pandemic real estate boom. And so let's look at, according to Redfin, let's look at what areas that show the largest rent increases. Raleigh and Oklahoma City saw the largest rent increases. In Raleigh, the median asking rent rose, wow, this is head scratcher, rose 21.8% year over year in November. The biggest increase among the 50 most populous metros. Once again, there are 400 MSA, Metropolitan Statistical Areas, according to the U.S. Census Bureau, and there are 9,000 counties, and there are around 10,000 cities. But Redfin on this report only addressed 50 most populous metros in which most of the Redfin real estate agents works at. So the more I look at this article, the more I feel these data are, it doesn't cover the whole gamut, the big picture. It just covered a segment. It covered the apartments renting 1 to 2 bedroom. What about single family homes? I suspect single family home renting on a month-to-month basis are higher than the monthly rental rates that you see on this particular article. Okay, that's just my take. So in addition to Raleigh, and Oklahoma City having the largest rent increases, it was followed by Indianapolis, Indiana, and Nashville. Think about what's going on. Oklahoma City, Indianapolis, and Nashville. And then this is what else? Cleveland, Ohio, also rental increases. Pittsburgh, Salt Lake City, Memphis, Tennessee, Cincinnati, San Diego, and Columbus. Out of the top 10 metros that show the largest rent increases, what's my takeaway? My takeaway is that half of these metros are in the Midwest, the so-called Rust Belt, the so-called blue-collar type of real estate markets, if you will. So this is not a negative thing, what I'm about to say. What I'm about to say is we've been hearing all the trophy markets in Austin, Las Vegas, Phoenix, and California, and Boise, Idaho, and all that. The trophy markets, very exciting markets, but the markets in the Midwest, which I just mentioned, is up and coming, because the markets in the Midwest, blue collar, Rust Belt, they are coming, they are growing, because the home prices in this region on a historical basis is very low, comparatively speaking, comparing to other fast-growing, skyrocketing housing markets in the Sun Belt, if you will. Does that make sense? Do you agree? So I see some good trends happening in the Midwest. Low home prices, but the home prices are appreciating in the Midwest market, believe it or not, based on my research. Why? Because, again, people are not necessarily moving away from the Midwest to the other areas. I suspect because they're still very low home affordability, still good economies throughout the Midwest. The cost of living is a lot lower. People want to stay. They don't want to move to Florida. They don't want to move to Texas. They don't want to move to Sun Belt, where home prices and rent have skyrocketed, especially in the past few years during the pandemic. If you guys agree with me, make a comment below. So anyway, let's continue. So medium asking rent, again, we're talking about apartment rents. Apartment rents are renting on an average of $2,000. That's pretty huge jump. It doesn't matter if they have decreased year over year in terms of rental increases. This kind of rent, if you ask me 5, 6, 7 years ago, these cities showing this type of monthly rent, I would be very surprised, because back in 5, 6, 7 years ago, you would not, these kind of medium-sized cities in the low-cost markets, no way they would be asking all of these rents, such high rents. And you know what I mean? So yeah, short term, year over year, some of these markets have decreasing rents, but the rents have gone up double digits in the past few years. So they have to come down back to the means, because let me tell you why. Because landlords in each local market, they cannot continue to raise double-digit rent, because you have to look at the income level. You have to look at the wages that our people make. Normally people can only pay they can only allocate 1/3 of their salary for housing, for renting and and what have you. If a landlord overcharge, if a landlord charge like raise the rent equal to half of someone's paycheck, I mean, people cannot afford to rent based on skyrocketing rents. So it's pretty obvious that in many major metros, as tracked by Redfin, the rental increases has to come down to single-digit level and not double or triple or even quadruple digit rental increases that has occurred in some markets recently in the last few years during the pandemic boom, such as cities like Tampa, Miami, Florida, Cape Coral, and Austin, and Boise, and Phoenix. They have raised their rent like 30 to 40% rental rates increases in a short periods of time in 2021 and part of 2022. So it cannot sustain itself. So just is the obvious things of what I just said. So continue with you could look at yourself, look at all the cities that showing the average rent. So this is kind of like a 2-bedroom houses, but for single family home renting, based on this rental rates on this specific cities, you probably can add 10 to 20% or even more higher rent for someone who's renting a single family home, a cookie cutter single family home with a good backyard. That's why real estate investors, you should buy entry-level single family homes as to cash flow to get the rent in, and single family home gets the best renter. They can charge the highest rent for obvious reasons, right? You want to rent to a young family with several small children with space, 3-bedroom, 2-bath, single family homes with a nice backyard, instead of charging rent for 2-bedroom apartments for this type of median rents on all these cities. Does it make sense? So the methodology that Redfin uses, they even admit themselves, they only, done the research on a mere 50 largest U.S. metros, and there's many more of them, metros in the U.S. evidently, which Redfin did not track. This analysis used data for more than 20,000 apartment buildings across the country. Okay, so apartment buildings renting for so much already. So, and single family home rentals can charge even more. So that's why I continue to preach real estate investors for you to buy single family homes, rental properties in the affordable markets in the South and Southeast. Rental family homes less than 300,000. Ideally, 200,000 to $250,000 price range, or the sweet spot for housing price range, because you can charge a renter to rent the single family homes for like 1,800 to 2,200. So these numbers make sense. The 1% rental value, the purchase price, $200,000 single family home multiplied by 1% equals 2,000. That 2,000 should be the monthly gross rent that we need to charge if to build the metrics of 20 to 25% down payment to get the cash flow. So 20 to 25% down payment, at the 1% rule, you buy $200,000 rental home, you charge $1,800 to $2,000 monthly gross rent. No matter, then you calculate the monthly debt service. At the end of the month, you should have positive monthly cash flow. So my takeaway is on what rental has just produced, Redfin has just produced, in that it just does not make economic sense to continue to be a renter. You realize that rents are increasing everywhere in the country, especially in the past few years. Behoove you. So landlords making a killing for these reasons. They're charging more rent. The rent is expected to rise in the foreseeable future because there's not enough rentals out there. There's a bidding war for rental as it is in many markets. So, myself as a real investor, have guided thousands of real estate investors throughout the country to buy in affordable, prudent real estate markets to buy entry-level homes around 200 to 200 to $275,000 price range, often new construction. So you can rent it out for $1,800 to $2,200. Those are the metrics in the South and Southeast. Of course, I also consult with many investors over many years to buy in the Midwest markets, where the older homes that are selling for $60,000 to $100,000 and get a more than 1% rent to value ratio. So the Midwest market for investors, for mom and pop investors, are good because the price is still very low relative to the rent they can collect. So the cash flow the yield is very high. And if you want more appreciation, newer homes, South and Southeast, like Florida, Texas, and Georgia, and Alabama, those are desirable places to buy. Newer homes cost more, but it rents a little bit more, but the cash flow is not as high as it is in the Midwest type of marketplace. But either way, both areas, both type of regions, geographic regions, are good for landlord, mom and pop investors to buy these type of homes for cash flow. You cannot cash flow if you buy in expensive markets like California or Boise or Austin or Phoenix, Arizona, or Las Vegas, Nevada. These trophy markets where home prices in these markets has quadrupled over the past few years, but the rent in these trophy markets have not increased to a level where mom and pop investors, even with 25% down payment, you cannot cash flow. The rent does not match the value of the properties that you're buying in the western region of the Sun Belt. Do you follow me? So buy in the South and Southeast and in the Midwest because the numbers make sense. The homes are cheaper. The rent is higher relative to the purchase price. And when you crunch the numbers with 25% down payment, you can cash flow. Right? So, and for you primary home buyers out there, you see this skyrocketing rent, you just throw your money away paying the landlord. So the sooner you can buy your primary home, regardless of interest rate. I know a lot of you are sitting in the sideline because the interest rate are in the mid sixes. But hey, if you can afford to buy as primary home. If you can afford a cash flow to buy good real estate investment markets, investment homes, if you can afford it as an investor, just do it, right? Because you're doing it for long term. It's really whether you're a primary home buyer or investor, you buy for the long term. You buy for 10 years or more, buy and hold, and you can overcome any kind of corrections. So that's based on history. The history is very kind to you. You have the ability to sustain the up and down the market. If you invest for the long term, 10 years or more, real estate has always increased in value over any 10-year period on a 2,000-year history of the world. Okay, so anyway, as I conclude my video, if you see value in watching this video, please smash the like button and subscribe to my YouTube channel, and also become a member of our real estate investment community. My website below, all you have to do is submit your email, become a member of our real estate investing organization, and you will receive weekly email free newsletters on great real estate investing opportunities in different parts of the country. Turnkey cash flow homes, all done for you. Thank you so much for listening. This is Siwin Yi. I will see you on the next video very shortly. Have a nice day. Bye-bye.